Good afternoon, everyone. Today we're going to look at the 4 principles of insurance. You will need to be able to identify, explain, elaborate, and name these 4 principles. So the first one is what we call indemnification, right? So indemnification applies to short-term insurance, as the insured is compensated for something that was proven to be harmful or proven to have lost him money. The insurer agrees to compensate the insured for the damages or losses specified in the insurance contract, but only in return if the premiums had been paid. So indemnification protects the insured against specific events that may occur. Payouts from insurance companies will only be made if there is proof that the specified event took place. That is why if you have a burglary, you have to go to the police station and get a case number to prove that something went wrong. The insurance company can then send an assessor to your home to view the losses that you incurred. If you have a car accident, an assessor will come and evaluate what losses you incurred. So indemnification is really about returning the insured to the previous financial position they were in before the event took place. So remember, indemnification also means that you cannot make a profit from insurance. You can only be returned to your previous financial state before the event took place. The second concept that we need to know is that of utmost good faith. So right in the beginning of this whole series, I said an insurance contract is a contract of utmost good faith. So in other words, the insured has to be 100% honest in supplying details when entering into the insurance contract. So for example, if I insure my household goods, I need to be very honest about the TV that I have in my room, in my house. I cannot say it's a curved TV when it isn't. I need to be honest in the details that I provide. If they ask if I've ever done any dangerous activities like skydiving, I need to say yes, I have. Because if I don't state that, and then I do have an accident while skydiving, I will not be paid out. So it's very important that honesty is in every single aspect of this contract. Both parties, the insurer and the insured, must disclose all relevant facts. That's why often with life policies, they will ask things like, how many glasses of wine do you have a week? How often do you exercise? Is there any previous history of diabetes or cancer in the family? Right? And if you lie on any of that information, they may not pay you out because you were not honest. So the insured must disclose everything that may affect the extent of the risk. Details or information supplied when claiming must also be accurate. It's not the right practice to lie when you are claiming for any losses that you incurred. The third concept or third principle of insurance is that of security or certainty. So it aims to provide financial security to the insured when he or she retires, or to the dependents should the insured lose their life. That's why I put the picture of that family there. It's about creating security for those left behind for the future should you not be there. So it applies mainly to long-term insurance, where the insurer undertakes to pay out an agreed upon amount in the event of a loss of life. So some people will have life policies to the value of 1 million rand, 4 million rand, and when that person passes on, that money, 1 million or 4 million, is then paid to the family, so they have security for the rest of their lives. The fourth principle of insurance is that of insurable interest. So the insured must prove that he or she will suffer financial loss if the insured object is damaged or lost or ceases to exist. So in other words, I have an insurable interest in my husband, right? Should my husband pass on, I'm not getting his income to help me raise my family. So I have an insurable interest in his life. I have an insurable interest in my vehicle. I don't have an insurable interest in the school's vehicle. I don't lose out if the school's vehicle is stolen or damaged or in a car accident. So you have to claim that it's going to affect you personally. You will suffer losses if it is an insurable interest to you. An insurable interest must be expressed in financial terms. Insured must have a legal relationship with the insured object in the contract, right? And that's why I use the example of my husband. But a business partner, you will have an insurable interest in their lives. You will have an insurable interest in creditors who owe you money. So let's just recap. There are 4 principles of insurance. They are indemnification, utmost good faith, security, and insurable interest. Please make sure that you study these very, very well.